Hello everyone, I'm Noah Lui, Head of Investor Advisory at RHB Bank. Thank you for joining us for our exciting time today. Just post the announcement on the budget 2026 for Malaysia. Together with us, we have Head of Regional Equity Research at RHB Investment Bank, Mr. Alexander Chia. Alex, thank you for joining us today. Comparing to the budget 2025, how would you characterize budget 2026 fiscal stance, allocation priorities, and policy signals, and which changes are most consequential for the markets?
Morning, Nova. Thanks for having me on the podcast. I would say that the 2026 budget is really an exercise in fiscal discipline, rooted in robust governance and really driven by ideals for reform and compassion for the welfare of the rakyat. This is a relatively significant budget in the sense that it is the fourth Madani budget and the first that is under the new 13th Malaysia Plan, the 5-year development plan. And overall, the proposals were fiscally expansionary as expected, but reflect a lot of restraint to ensure that fiscal discipline is complied with, to ensure that the sovereign rating agencies have no issue with the direction of the deficit. In which case, the budget has factored in a declining fiscal deficit target of 3.5%, and this is down from the 3.8% that is targeted for 2025. This also included 338 billion uh, ringgit in OPEX and 81 billion in development expenditure. So overall, I would characterize this budget as being broadly neutral for equity markets overall. There were no major surprises one way or another. But I think in terms of sectoral impact, I would say that given that we have seen a bit of run up in the consumer sector, given that there were pre-existing expectations of significant increases in support for the low income groups and the civil servants, with high expectations for higher STR, higher SARA, and so on. And I think expectations have probably run a little bit ahead of reality. In what we saw yesterday in the budget, the STR and SARA fiscal support programs were maintained at 15 billion for 2026, which is the same level as what we saw for the whole of 2025. There was also some mild tax increases for the tobacco and brewery sectors, but they weren't excessive in my opinion, and it was something that was probably somewhat overdue.
Thank you, Alex. You did mention that you think the equity market will be a little bit more neutral per se. So, what is your base case on the immediate reaction next week, or potentially can you give a little bit more granular in the coming months towards potentially first half of next year on the equity market? Is there any sector that you think you perform differently from the market expectation? And what do you think of the foreign inflow or outflow from our equity market?
Okay, right now, we are already well into the last quarter for Q25. And I think in terms of generally how institutional funds have formed for the year to date, I think they're in a fairly comfortable position. And I think most insti funds are on track to meet their 2025 target, assuming no major unexpected black swan events occurring in the fourth quarter of 2025. So overall, I would characterize this last quarter of the year as a somewhat transitionary quarter in terms of uh, you know clients looking to position themselves for 2026. To that end, given that the markets are up easily 100 odd points on the KLCI since the beginning of August. And right now, markets are already trading at the 1620, 1630 kind of range on the FPM KLCI. And that is already in the zone where we think the markets will close at the end of 2025. And this is in line with street expectations, where year-end targets are probably around 1650 kind of mark. So in the short term, I would anticipate that we would be advising clients to perhaps take some realize some gains in the short term, and to take advantage of the strong recent run up, but also look at how we should be positioning for 2026, in a sense of looking at the stocks that have been seen as laggards, for one. We would also be looking at focusing on some of the sectors that we think will be in play for 2026. And to this end, we would be looking at areas such as the Johor Singapore Special Economic Zone, which is still an area that is attracting a lot of investor interest. Number two, we would also be looking at opportunities in Sarawak. Number three, construction. Number four, initiatives in the renewable energy space. Number five, energy infrastructure. And number six, water infrastructure. Right. So those are the areas for 2026. We would be looking at laggards, and beyond the large caps, we would also be looking, if the market does end up being frothy, we would also be looking at some of the second and third liners going forward.
Alex, is there any part of the budget 2026 turned out to be a positive surprise for yourself?
Well, I think, like I mentioned earlier on, there wasn't a great deal that was, that really swept, observers off their feet. It was a responsible budget. It was largely expected. The thing about the construction sector was that, while a lot of mention was made for some of the smaller projects, there was no mention of some of the uh, high high impact projects such as the MRT3, the KL Singapore HSR, the JB elevated autonomous rapid transit projects. There was no mention of that. Although we think that we can still expect eventual news flow on these major projects going forward, one way or another. But yeah, I mean, there wasn't anything major. There was a lot of emphasis on Visit Malaysia Year 2026. There was a pretty sizable allocation for Visit Malaysia Year in excess of 700 million ringgit. And I think that will mean a positive impact for some of the consumer subsectors, including commercial REITs, including transport and hospitality. Other than that, there weren't any kind of major surprises, either positively or negatively, that will cause markets to react strongly in the week ahead.
There may be a quick recap or a summary of what you think of the tactical playbook for the investors post the budget announcement.
I think right now, it's really not a top down, choose this sector and you do well kind of thing. It's really more of a bottom up approach. So right now, at the end of the day, it's always about stock selection, and we would be looking at, in the short term, we think markets will trade sideways, relatively, sideways for the rest of the year. there isn't any major reason why we should expect a strong window dressing activity as we get through to December, given that most GLIC funds are already performing relatively well. And I think they're fairly close to meeting the 2025 targets. So there's no strong reason to suggest why there should be a aggressive window dressing close. As a result, because any aggressive close, for this year would just mean a bigger hurdle uh, to outperform in the year ahead. So we think that markets will be somewhat range bound in 2026. Like I said, take some chips off the table, realize some gains, and position yourself in some of the laggard names that we like. In our recent 4Q 2025 strategy report, we have a list of laggard names in the report, and also a list of our topics. So you can refer to that report to get further granularity.
Lex, as we speak now, so coincidentally, there is news between the US-China tension, where China applying more control on export of rare earth, and the US has also announced that they may even increase 100% tariff to China. So on this backdrop, there's some volatility in the global equity market. How do you think is a spill over to Malaysia?
Well, I think any escalation of the US-China trade war is going to be negative for investor sentiment. But I think the markets have learned over the course of the last 8 to 9 months that we should, ultimately discount, a lot of the threats that with regards to the use of tariffs for either for trade or for political reasons.
What about your view on the property sector? The government has increased the tax for the foreign buyers, but at the same time, with the tax for first home buyer for property below 500,000, is that actually net positive or net negative for the property sector?
I would say it's fairly neutral. I think most of these measures are not especially new. They have already been in place, in previously. So what the government wants to do, I think, especially in some of the hot zones like Johor, to ensure that the property products remain relatively affordable for the masses. So overall, we didn't see any kind of new material significant measures affecting the property sector in last night's budget. And overall, the impact to the sector is going to be neutral. There were some concerns over potential tightening measures, but but I think as it turned out, I think a lot of the initiatives that we saw is going to be pretty mild, have a pretty mild effect on the sector overall.
Thank you again for sharing with us today, Alex. When it comes to investment insight or market update, it's not only the information but also the timeliness of the information shared to our investor. I hope that with the sharing from Alex would provide a better insight for everyone to make a better informed investment decision. See you again in our next podcast series.